So to start off with, everyone that knows real estate knows real estate's all about location. So kind of think about the criteria that we look for first whenever a build for rent opportunity is kind of identified. The first thing is obviously location, right? The three main things that I always look for in terms of location are, number one, proximity to roads, proximity to interstates. The second is proximity to population centers. And the last is proximity to amenities. In all four of these, I'll actually identify all three of those three components and show you why I think these projects are worthwhile. So location is number one. Number two is tailwinds. Once I figure out where the dirt is and whether or not it kind of fills or checks these three boxes, I look for the tailwinds of the market, meaning there has to be something going on with the market that's going to make it seem like a good investment opportunity for the next 5, 10 or more years. I call those tailwinds. I look for economic trends and population trends. If people are moving to an area, they're usually moving to an area for a couple of reasons. Number one is jobs. Number two is lifestyle and cost of living. So when I look at these projects, I'll kind of go over that as well. And then once these things are kind of looked at and confirmed, then I look at the numbers. And for all four of these projects, what I'll be doing is I'll be going over the numbers and showing you how we figure out what the returns are and what they need to be in order for them to be interesting to us. So with that, I'm going to bring up kind of the first deal here, which is a project called, which is a 150 townhome development in a place called Commerce, Georgia. Okay, so before I kind of dive into anything else, let's look at the location first. So if you look at the location of Commerce, Georgia, and you swing up and you look at where Commerce is in relation to Atlanta proper, it's a ways away. This is not exactly a bedroom community of Atlanta. I would consider this a bedroom community. It's about 70 miles northeast of Atlanta. So it's not going to necessarily benefit from a lot of the fundamentals of Atlanta. But if you look closer, you see that the land is just adjacent to some older subdivisions, some already built out subdivisions. But you think about those three check boxes: proximity to interstate, proximity to population, and proximity to population trends or population. Or what you'll see in this deal, in the Commerce deal, the land is well positioned. And if you kind of look at a map, which I have here, for Commerce, Georgia, you'll kind of see what I see. So this is the place where the subdivision is slated to go. I look at it and I look for proximity to an interstate. So you can see that Commerce, Georgia is right off the Interstate 85, and this site that we plan on building on is within probably a 10-minute drive to the interstate. So, it checks the first box. It's close to an interstate. You look at it in terms of proximity to a population center. Commerce is not a big town. Commerce is not in itself a huge population center, but it is a population center. It has all the amenities like restaurants and retail that you would expect in a thriving town. So both those things were fine. But here was the interesting thing about Commerce. The tailwind for the market was really the driving factor here. And what I found out about Commerce, being that the dirt is well located and being that the actual location is close to an interstate, I looked at this new tailwind as being almost like a no-brainer. There's a company called SK Innovation, which is a EV battery producer. They produce batteries for hybrid and electric cars. They just built a $1.6 billion facility. It's built, it's functioning. They have about 200 employees there right now, and they plan on hiring another 2,600 employees over the next few years. Now, me being the ever inquisitive guy that I am, I called up people around town that knew about the SK Innovation Plan. And what I found out is a lot of the employees that they're going to be hiring are actually going to be coming from overseas. And when I talked to rental companies in there, what I found out was because these people speak a common language and they have a common culture, they really want to live close to each other. So as of right now, they're actually doubling up families in Commerce in rental properties because there's just not enough rental stock. So if you think about the opportunity to build what this is a 150 unit subdivision in one area that's literally 5 minutes from the SK plant, you think about if you work there, it's really a very strong value proposition to work at SK and to live in a full rental community that's just minutes from the site. If that wasn't good enough, there was another site that was just built there in 2018, which was the GE plant. GE Appliances built a smart warehouse in Commerce in 2018, $55 million. It's totally up and functioning right there. It only employs about 100 people. But when you have this much building for industry going around, what you get besides the actual employees that work for the site is you get retail shops, you get restaurants, you get businesses that come to the area because there's a higher demand for those services. So I looked at this and thought, what a great opportunity to build a good, solid, large build for rent deal. The dirt's well positioned. There's tailwinds to the market. It's close to the interstate. It's close to population centers. And if you look at the actual map here, you'll see it's right next to retail, including Walmart, Tanger Outlets, and all along this corridor, you have restaurants, you have retail, you have all the things and amenities that people look for. This is the site. This is the SK plant. This is the GE plant. Couldn't be better positioned. So then I dug into the numbers, all right? And here's how the numbers looked. And this is how we go and analyze most deals. We really break it down into 3 different components. It's the land costs, it's the building costs, and then it's the income and expenses, right? So for this deal, we knew that someone could come in and the builder who brought us the deal actually already has this under contracts. Here's the lot costs for entitled dirt. It's $16,000 an acre. I'm sorry, $16,000 a lot. So $16,000 per lot. There's gonna be 150 lots on the site. We worked with the builder to figure out the lot development costs. They pinned it at about $35,000. So the total lot price is this. We figured in Strata's fee. So the total lot cost is about $54,000, which is great. We worked out a deal with the builder that saw the building price per square foot of the units they can build being about $61 a square foot, which means the all-in cost to build, including builder profit per unit here, is going to be about $136, $137. And we add those 2 numbers together, you get an all-in cost per unit of $190,000 per unit. Average size unit is going to be about 2,000 square feet, right? Which means it's a 150 unit subdivision filled with 2,000 square foot homes that the builder is really good at building. They build a quality product and they always come in on time and on budget. We pulled rental comps, which you'll see right here, and we pulled sales comps. That informed us that that unit should rent out for an average of $1,630 per month, okay? Smaller unit will rent out for $1,530, large unit should rent out for about $1,800. And that informed us about how we can get to a cap rate. We layered in actual taxes using a millage rate. We layered in management fees, insurance costs. We figured in an HOA fee and maintenance reserves. And when I go down and look at the expense load, I need that number to look and to be anywhere between 35 and 40%. Generally, no matter where we go in a good build for rent market, the expense load is going to range between 35 and 40%. This landed at a 36% expense load, meaning we got to a total operating budget of X. And here's where it all kind of comes into sharper focus. This deal, if my numbers play out correctly, should be a 10.2, 10.3% gross yield, which equates to about a 6.2% net yield, right? I know that most institutional investors for this kind of development risk are going to want to land somewhere between 6% on the extreme low end all the way up to about 6.5, maybe even higher. And because these numbers are what they are, if my numbers play out correctly, we're right in the middle of that range. We're at 6.2%. So what Strata does is we don't necessarily go out there and take listings. We go out there and find quality projects. We put all the puzzle pieces together, the lot developer, lot owner, the builder, and ultimately put those things together and deliver a project to an institutional investor that has to understand all these things in order to make a play for it. So that's Commerce, Georgia.